Hey everyone, and welcome to This Explainer. It's May 19th, 2026, and look, the crypto landscape is going through an absolutely massive transformation right now. We're literally leaving the old, purely financial phase in the dust. Instead, we're stepping into this wild new reality where autonomous software, massive regulatory pivots, and honestly, some pretty existential tech threats are completely rewriting the rules of the game. I'm super excited to guide you through all this today, so let's get right into it.
But first, before we get into the heavy stuff, let's ground ourselves in the data. Right now, even with all the recent geopolitical surges, like the huge news about the Strait of Hormuz fully reopening, Bitcoin has found what analysts are calling its true market mean. And that number is exactly $78,500. Keep that number in the back of your mind, because while that price looks stable today, the entire infrastructure underneath it is shifting at warp speed.
Okay, let's look at our roadmap for today. We're going to cover the accountability shift, the automation boom, new systemic risks, ecosystem governance, Bitcoin's quantum dilemma, and finally, we'll loop back to that true market mean. Let's kick things off with Section 1, the accountability shift and our new regulatory pivot. This first major shift sent absolute shockwaves through the industry this week. Back in 2024, the SEC's whole vibe was regulation by enforcement. They were constantly wielding these massive lawsuits as proof of how tough they were. But now, in 2026, they're doing a total U-turn. They are fundamentally rewriting their approach and actually disowning their own playbook. They're reportedly dismissing 7 major cases they used to champion. It's a huge pivot away from constant litigation toward building a real, institutionalized market structure. So the big takeaway here is that the era of enforcement-first regulation is pretty much wrapping up. In its place, the SEC just granted a 5-year broker license window for self-custody apps. Guys, this is a total game changer. It gives these platforms a much clearer runway to operate and actually integrate into traditional finance without constantly worrying about getting shut down overnight. Now, moving right along to Section 2, the automation boom and the agent economy. Because just as that regulatory pressure starts to ease up, the market is slamming headfirst into a massive technological leap. We aren't just talking about people trading digital tokens anymore. We have officially entered the $28 trillion agent economy. This is a system where AI agents are literally using APIs to hire humans for physical world tasks. A crazy example making headlines right now is rentahuman.ai. Just think about that role reversal for a second. We're not just using the software anymore. The software is using us. There's a quote that brilliantly sums up this shift. It says, "Humans are no longer the primary operators of the blockchain, but rather physical endpoints for autonomous software." I mean, wow, it sounds like science fiction, but it's happening right now. Capital flows are increasingly machine-led, and the blockchain is just the perfect frictionless background for these AI agents to settle their payments. Of course, handing over our financial infrastructure to AI comes with a massive catch. Let's look at Section 3. New systemic risks and machine speed threats. I really want you to ask yourself this. Is technical security the new price action? For years, institutional confidence was all about charts, yields, and green candles. But now, we're in an era where AI can scan and exploit smart contracts in actual milliseconds. Technical security is rapidly becoming the absolute baseline requirement before anyone puts serious capital into the space. To show you just how fast these threats move, look at this recent supply chain attack that cybersecurity experts have been warning us about. Basically, malicious wallet-stealing code was quietly slipped into a really popular AI tool called LiteLLM. Because AI processes things instantly, this compromised software executes at machine speed every single time it's run. So before a human can even blink, the system is silently stealing SSH keys and crypto wallet data. It's wild. And this isn't just theoretical tech talk. It's caught the attention of the highest levels of government. The Federal Reserve and the Treasury issued a really stark warning, stating that Anthropic-class AI, like that highly secretive Mythos model, poses a live threat to shared financial infrastructure. We are dealing with weaponized systemic risk here. An exploit can jump from a tiny bug to a massive, irreversible on-chain loss in a fraction of a second. When the stakes get that high, the big players have to step up. Let's move to Section 4. Ecosystem governance and stablecoin power plays. The stablecoin market has just blasted past an astounding $320 billion. And mostly what we're looking at here is a fierce head-to-head battle for global dominance between Tether's USDT and Circle's USDC. The sheer scale of this liquidity means whoever controls these rails basically controls the future of digital finance. Which brings us to a super fascinating power play. Recently, the Drift protocol got hit by a massive exploit. But Tether didn't just sit on the sidelines. They swooped in and committed $127.5 million to the recovery plan. Let's be clear, though, analysts don't see this as some charitable bailout. It's a strategic coup. Tether is actively buying market share on the Solana network to challenge Circle's dominance and force a new USDT standard for payments. These stablecoin issuers aren't just passively providing liquidity anymore, they're actively governing and defending the ecosystems they want to own. But it's not just a fight among crypto companies. They're also battling traditional finance. Just look at a recent Nomura survey out of Japan. Japan has historically been a massive stronghold for XRP, but despite that, Ripple's new RLUSD stablecoin is hitting a brick wall. Why? Because institutional investors there overwhelmingly trust stablecoins issued by massive TradFi megabanks, and they have very low trust in crypto-native issuers. Right now, trust is the ultimate currency. Okay, we've covered AI threats and stablecoin wars, but we have to talk about the ultimate existential risk. Section 5. Bitcoin's quantum dilemma. As quantum computing gets more advanced, older Bitcoin wallets are becoming vulnerable to being cracked. It's presenting the network with a truly impossible choice. There's this new proposal, BIP361, that basically forces the network to decide. Do we freeze those vulnerable Satoshi Era coins to protect the network from quantum theft? Or do we just leave them alone and risk them getting stolen? Critics are heavily pushing back, calling the freeze option monetary suicide because it directly threatens Bitcoin's core promise of fixed scarcity. And listen, if you think this is just some sci-fi debate for way down the road, the timeline is accelerating way faster than people thought. A major quantum readiness paper dropped in 2025, and right now, in April and May of 2026, the debate over BIP 361 is absolutely raging. Experts are projecting 2029 as Q-Day. That's the day quantum computers become powerful enough to break modern cryptography. So this is a very real, very fast-approaching deadline that the market is having to digest right now. Which brings this whole explainer full circle. Let's finish up with Section 6, the true market mean. So, what's the bottom line here? Keep your eyes on that $78,500 level we mentioned earlier. It really is the true market mean right now. The market is currently absorbing some massive structural shocks. Everything from those crazy AI-driven supply chain exploits to this deep philosophical quantum migration debate. If the market manages to digest all of this smoothly, we're likely going to see a historic transition. We'll be moving away from old-school retail fear and stepping into a highly efficient, agent-driven rally. I'll leave you with this final provocative thought to chew on. If AI agents are acting as our new employers and stablecoin issuers are behaving like highly active central banks, who is actually operating the blockchain today? Automation and accountability are quite literally rewriting the rules of money as we know it. Thanks so much for hanging out with me for this explainer. Keep your eyes on the data, stay curious, and I will catch you in the next one.